And then before you knew it, that wave was bigger. And what looked like a headwind for a moment actually turned into the biggest secular tailwind we've ever seen, maybe ever will. So we talked then 3 years ago about how we fuel the world's growth. Yeah, she said it looks the same. Yeah, I may or may not be wearing the same suit. It fit better back then. No, I don't think it was the same. I don't think I would have fit into that one. A couple things that we said from that investor day that I just wanted to talk about. So I'm going to go quick because you already heard this presentation, or many of you did. I said back then CTV and video will be our largest channel. It already is. So we said roughly 5-year time horizon. Again, that was 3 years ago. It already is. We said that our ID footprint will be larger than any single company's login footprint. We have, and Samantha's going to go over this in more detail and be more precise in the numbers, but we have over 3 billion devices that we see on UID. As you know, UID2 is an open source, so it doesn't mean that we see everything. Everybody has their own instance and can use UID their way. But just the ones that we see, over 3 billion devices. Of course, many of you know that Google has about 3.2 billion logins. Logins and devices are a bit different, but having over 3 billion devices, we're well on our way. So I am confident that this statement will be true in the time horizon that we said. Grow data usage at least twice the pace of media spend. We've lived this. The pandemic accelerated that. And honestly, economic slowdowns, recessions make it so that people become more deliberate and more data-driven in the choices that they make. So if that's what's ahead for us, people will become more deliberate, more careful about the way that they spend and expect more from every dollar. The only way to do that is with data. So I said then China will become a top 3 market for the trade desk. There are a number of things that are, my notes are different than the ones that I sent them. I'll speak to the notes that I wrote instead of the ones that are up here. But a couple things on China. First of all, most marketers are afraid of it. They're afraid of it because it's different, because the government plays a different role in the China market than the one that they have in almost every other part of the world. And so when you're looking to make investments in China, you tend to underinvest compared to the opportunity that exists. And so what most brand marketers want is somebody that they can trust, especially with their data. And we'll talk more about the way that we've won trust for the biggest brands in the world. But that represents an opportunity for us that is very different than other companies going into China, because we bring money into China. So different than taking it out. Now, there certainly are huge opportunities for us to do outbound, like we have, like Facebook has, for instance, where you take Chinese companies and help them advertise the open internet around the world. But then, of course, there's opportunities to advertise domestically. Last year, this was our fastest growing office around the world. Of the 30-ish that we have around the world, this was our fastest growing, both in terms of spend growth as well as just growing our team. So China continues to be a tremendous opportunity for us. Of course, there's been a bunch that changed because of COVID and geopolitical issues. But I think slow this down a little bit in terms of becoming a top 3, but I still have as much optimism as I ever had for the opportunity in China. So we said back then price discovery is foundational to healthy markets. That's even more true for us today, and we're even more focused on it than ever. We also said that data-driven is better than guessing. That's fairly obvious. But there's a lot of guessing that goes on in advertising, even today. It wasn't just in the Don Draper era. It continues today. And that's essentially what we're replacing with what we do. We said then, we spent a lot of time pointing to the $1 trillion TAM. And that was before we diluted the dollar a lot and then built it back up. But one thing that we didn't really foresee and didn't quantify as well as I think we could have is just the opportunity that exists in shopper marketing that actually widens the TAM. So that $1 trillion TAM, we're about 750 billion today. We're on track for that to happen. But you can argue that of the 500-ish billion in shopper marketing, that if half of that is available or part of what we could address today, that we're already at $1 trillion TAM. So we said then that we want to empower agencies and get closer to brands. I don't know that we've lived up to any of the statements that we made in 2019 more than we did this one. We've just done this so well. The team has done this so incredibly well. And we'll talk more about how we have. But, this is again, something we've said in the S1. We said in the document that I wrote that was basically the preface to a business plan 13 years ago. The buy side will always be in the power position. So we said this then. I just think it's really important to note this because you can get confused by this, and especially as you look at CTV and some of the really strong position that quality CTV content is in, but then also some of the positions that other tech players are in. And sometimes when somebody that has a lot of supply doesn't do well on earnings, people assume that's going to affect us, and I think often it does not because we lose sight of this fact. In advertising, there is more supply than there is demand. There always has been and always will be. The reason why that's true is because you can put up now showing ad 1 of 3. And then during political season, you can make it now showing ad 1 of 5. There's no reason why you can't add more supply, especially in a digital environment. And so given that fact, it is always a buyer's market, because as soon as you get close to equilibrium, you can create more supply. So from our perspective, the way to create the very biggest company and capture the opportunity is to make certain that we align our interests with the buy side so that we're working on their behalf and using that power position to align and grow and do something different than those that are big trying to service both sides that are full of conflict of interest. We're going to spend a lot of time talking about conflict of interest today. Decisioning is where the media, or is where the money is. I actually don't think I need to spend time on this because all of you live that. Inside of equities markets, commodities markets, that's proven over and over every day. Those that decide what to buy and sell are the ones that make the money. So this is one where I feel like I was only half right, and I'm going to spend a lot of time explaining why today. But sell side will continue to specialize in fragment was a statement that I made 3 years ago. I believe that the specialization is happening everywhere, and the fragmentation has happened in CTV, but the fragmentation has not happened on most of the browsing web and in most of mobile, and we'll talk about why. We said then, we didn't actually create a slide for this then, but we did say this then, that we're obsessing about supply chains. I think one way to summarize the success of Amazon is just that their executives obsessed about supply chains. How do we make them more efficient? And if we make them sufficient enough, we can ship product at the best prices and in 2 days. It sometimes, at least at an aggregated level, is just that simple. If you obsess about supply chains and make it more efficient for the people that you represent, you can create something that hasn't been done before. And that's, I believe, critical to our success is that we obsess about supply chains. I think there have been times in our company's history where we've said, if we focus on the buy side, the other parts will take care of itself, and that's not necessarily true. At times we have to disrupt the inefficiencies of the supply chain as fast as possible in order to best represent our customers. So I said then that I believe the buy side aggregates around 3 to 10 players because there's economies of scale. And I said then that objectivity matters more tomorrow than it did today, and it matters more today than it did yesterday. That's a complicated way of saying every day that goes by, objectivity matters more. Google, Apple, Amazon, Meta, they all have a place in advertising. We said then that they have to get into this space. And there were some questions about, like, will Apple get into this space? Of course they have to get into this space. A multi-trillion-dollar company has to be touching things that have trillion-dollar TAMs, and advertising is more orthogonal to their business or closer to their business than drilling for oil is a comment that I made back then. I'll stand by it today. So, of course, they're going to get into the space. But none of them really have a place in objectively buying the open internet. And most of them are trying to monetize supply of their own. And it actually creates a very complicated problem for all of them because much of the inventory that they have, they're swimming in it, and their cost of goods sold or TAC is almost zero. And when you contrast that to things that are very expensive, like premium content and CTV, it becomes very hard to have that barbell strategy where something's very expensive and something's almost free, and then to monetize those well, and especially make good trade-offs for the advertiser. So many of those, like Meta, for instance, at one point tried to monetize the open internet, and has since said, we're just going to monetize our sites. And I think there's some wisdom in that, especially because I think there's some honesty in saying to your advertisers, yeah, I think mine's the best, and I'm going to try to help you monetize there, which is different than saying, I'll objectively help you buy the internet, and by the way, I think you should spend 90% of your spend on my stuff. So at least one winner will be independent, and I think it's likely to be the biggest as well because of that objectivity. And especially if there's only one objective player, which seemingly is the way that it's shaping up. In the last 3 years, a lot has changed in terms of the competitive landscape of open internet DSPs. I think we've clearly led the pack. We're the most likely to be the winning independent and objective player, and I think that also means that we're the most likely to be the biggest. So that was a look back. I told you it would be brief. It wasn't too long. And now I want to talk for a minute about some of the macro forces that affected our business. Some of these are fairly nuanced. Talk about the landscape. Starting in March of 2020, the wave got a lot bigger. As I mentioned, in January of 2020, I said, I'm really concerned that the wave is too big, or bigger than we can be ready for, and we just have to work as hard as possible to be ready for it. For instance, this year, we set a goal to hire 1,000 people. I wouldn't have thought that we would have done that in early 2020. Incidentally, we're on track to hit that goal. And it's not been without lots of work to protect our culture, to protect what we built, and to be very organized, but to continue our focus. And thank God we had a very clear vision and a very clear focus going into the pandemic, because those that didn't really struggled. Especially if your strategy was one where you say, hey, let's just try to respond to the times and we'll figure it out, which a lot of ad tech companies have done that. Like every 6 months, they're just sort of reevaluating and they just kind of shift. And especially if you're a public company that does that every quarter, which seemingly some do, then you're in big trouble when the world changes as much as this did. But our focus has always been the same. Our vision has been the same. We want to represent buyers objectively, and we want to help them make the decisions on the entire open internet, and we believe you have to be global and omnichannel to do that. So the use of data-driven advertising surged. So it's actually, I think, difficult to explain holistically why this happened so much. I mean, some of it has to include cuts. The decks are out of sync, whoever is moving the decks. Some of it were because people had to make cuts. Early on in the pandemic, of course, there were supply chain issues. Of course, people are expected to do more with less. Of course, there were some companies that had, especially big companies, that had weird comps, and that meant that the advertising spend was lumpy. But really, everyone was expected to do more with less. And especially when you take advertising teams, and advertising by its nature is a very collaborative thing, right? And the agencies typically are very collaborative in their culture and the way that they operate. That was extremely difficult for them to do in a pandemic where everybody's working from home. So the only way that you can be disciplined in the way that you spend is to be data-driven. You put all of these things together, and everyone had to become more data-driven, and that's exactly what they did. And it meant that programmatic moved up. So as I mentioned, global advertising continues to the path of $1 trillion, and then of course there's the expansion of shopper marketing, where that is all coming together. When you shopper marketing, of course, when you add loyalty programs and sponsored listings and all those things, you get to roughly a $500 billion TAM. And I think over time, most of that is available to the trade desk. Even things like sponsored listings, where it's just optimal for those to get as much demand as possible. And again, back to there's more supply than there is demand. Welcoming as much demand as possible it becomes increasingly important. So let's talk about some of the biggest players in tech and just some of the most controversial issues that are facing the landscape today. So rumor has it that the government is going to file suit against Google any minute now, and that Google is really stuck between privacy and antitrust. And honestly, they keep, in my view, oscillating between which one they're trying to respond to and which one is the bigger threat. And what I think this has done is made it so that it's very hard to get things done inside of Google. So we've had some tell us that it feels like Google is run by lawyers today as they're trying to navigate these two very different issues. We'll talk more about that, but that does make it so that Google is operating a bit more, they're a bit more slow in the decisions that they have to make, and that represents an opportunity for us, which again, I'll talk more about in just a second. Let's talk about identity. So as long as we're talking about the big tech, it's impossible for us to talk about what's going on the internet and the landscape of the internet without talking about identity. Now, identity is just shorthand for the concept that there has to be a way to understand anonymously and in a privacy-safe way who a user is consistently. And by who a user is, I don't mean their name, social security number, or anything like that, but instead in an anonymized way so that you can provide personalized content relative to the interests of an individual. And everyone is trying to figure out how to do this, and everybody has different opinions about the way that it should work. And I just want to walk through what that war looks like. It really is the open internet against, I would say, two companies, Google and Apple. And if it looks like Apple is a bit of a Pac-Man heading towards Meta, that is probably what it feels like to Meta too. Where if you were trying to explain how Meta lost almost half of its market cap, I don't think you point to the macro trends nearly as much as you do the war on identity. So I don't think that it's well understood what's happening in identity. I don't think that the land grab is well articulated, and so I want to try to take a minute to talk about it today. I believe that there's really two primary approaches to identity. And when you abstract them, they're very philosophically different. One is saying, I'm trying to aggregate all the power. And sometimes the rhetoric is, I'll take care of this for everyone. And the other one is trying to federate it all. It's almost like an authoritarian government versus a democratic one. How do you handle power? There is no question that there is power, but one is trying to aggregate it all. The other one is trying to distribute it. And the risk of this is that there's a bit of asymmetry in this, and it also is, the risk reward, I think, is very different. I'll come back to that point that I was just going to make. The reason I put this up here is because the war, maybe the past image is important because there's a sword and a shield, and privacy in particular is being used as a sword and a shield. It has been weaponized, but it's also a defense to prevent big companies from being auditable or sharing any insider data. So it creates less transparency in the overall marketplace. But you could also say that it's a Cold War, and that it's very subtle in terms of the way that it's being interacted, or the warfare is very subtle. And this is a great example of that. I would argue deliberately, ask the app not to track. I don't know what that means. If I ask them, what if they say no? What do I do then? This idea that on this one, we turn it on because it will make things better. On this one, are you sure you want to allow it? And sometimes the prompts become even more one-sided. But really what Apple has done is created, I think, a misperception. I don't know that it was deliberate, but I think it's happened anyway. The misperception is really what I say there in 4, which is they created the perception that they manage privacy for the entire internet. I think many consumers think that this is supposed to protect the entire internet. And really what Apple is doing is they're protecting their ecosystem. As long as you stay inside of their ecosystem, they are taking privacy very seriously. I don't think you can dispute that they're taking it seriously. But the debate about what tactic is the best, I think, is a real one. Because you're aggregating all of this data, and because I believe what Apple has inadvertently done is created themselves as sort of an intermediary for consumers on privacy. I think that comes with great risk. Because if the consumer misunderstands, or if bad things happen when you're in the middle of everything in privacy, which I would argue they will, I think that is inevitable, then you have set yourself up for a risk reward that I don't think is worth it. Which is why I argue at number 5, I don't think any company should want this job. No one should set themselves up to be in the middle of all of it. So I believe the only answer, and this is, I believe, where we land, irrespective of how long it takes us to get there, when the risk reward gets weighed out, we will end at a place where consumers can clearly understand who they're taking risk with. So they have a relationship directly with individual companies, and they choose where they decide to trust people. And then they have control over those settings, and they can undo it. And only with this type of setting do I believe that we can comply with things like GDPR and all the rules that are basically include things like the right to be forgotten and control and consent. So one analogy that I've used, every analogy is imperfect in this, but I think it helps, is there are companies who are saying, why don't I create the biggest safe in the world, and we can put all the data in there. And especially the sense of identity, which centralizes the way that data gets used, we can put in this central database, and I'll have eye scanners and really thick walls, and we'll talk about all the things that we do for security, and we'll put it all in these 2 amazing safes, or 3 or 5. I think that poses a too big to fail risk. That is as great, very different, but as great as the 2008 global financial crisis, where we say we've created something that's too big to fail, except for the entire internet is based on it, and including the way that the entire internet is monetized. You look at the trickle-down effects, for instance, of Facebook being less effective in their targeting since identity has been weakened a little bit. But the trickle-down effects include lots of small businesses that are much less effective than they were before. And if you're less effective and yet still taxed at the same rates, then it has a devastating effect on the economy. Now, if we've done that inside of one company, what if we do that in regard to the entire internet? So essentially one way, and we're going to talk about it in more detail, and Samantha's going to cover this better than I will. But one way to describe what UID does is instead of having 2 safes or 3, we have 1 million of them, and millions of them. And now what some will argue is that by having 1 million safes, you have more security risk. And you're right. You are right. You have more security risk, but it doesn't mean a bigger one. It's okay if you put $100 in the hotel safe and use the passcode 11111 because you're risking $100. I think the greatest risk to the system, to the internet, is to put it all in one place. And especially when you consider the fact that every database in the world has seemingly been hacked, whether we're talking about NSA or FBI or Microsoft or wherever. Like everyone has had some security breach, and if you put everything in one place, that just creates a risk. The very first rule we created when we laid down the gauntlet for is to not create any honeypots, is what we call them. Don't create a central place where everything can be stored and everything can be robbed. That is the problem. And do not move data unless you have to. So when a company has data, let's not say, step 1, put it in our system. We think that is inherently dangerous. And that is different than what many of the biggest companies in the world are asking of brands and advertisers and credit bureaus and so many other companies. So much more to come on UID. But I find this to be extremely interesting. I probably spent more time thinking about Google in the last year than I did in the last 10. And it's interesting because I think that might also be different in the way that Google thinks about us. When Sundar was at Code a few months ago and was asked by Kara Swisher, who's a very direct interviewer, you say you have competition, but where's your competition really? And he pointed to TikTok and the Trade Desk. I thought it was very interesting that he pointed to the Trade Desk, in part because only 3 months before that I was sitting at a dinner next to Eric Schmidt and I introduced myself and I said I'm the CEO of the Trade Desk. He said, oh, what do you do? So I've spent a fair amount of time thinking about how did Eric Schmidt not know what the Trade... And by the way, we then went on to talk about what the Trade Desk was, and it was all new to him. And if you weren't following dates, he was CEO of Google for 10 years. Then he was chairman and has been an advisor up until 2020. So it's not that we were non-existent, but it is also true that even today, we're only 2% of Google's market cap. So to point to us as one of the biggest indications of competition, I think is interesting. So let me take a stab at explaining why I think those can coexist. And this is just me giving you my theory and spending a lot of time watching what's happening inside of Google. So we say all the time, we don't compete with Google, big Google. We don't have a search engine. We don't have fiber in the Pacific Ocean. We don't have a space program. We don't have self-driving cars. We don't have a user-generated content video platform. We don't have a publisher or ad server. We don't have a browser. And all of those are some of the, what I would call, priorities 1 through 36. We compete with priority number 37. I believe that priority number 37 doesn't really move the needle on a Google P&L. And that's one of the things I think is beautiful about competing with Google and what we do, especially because we do it objectively. But I think the combination of us doing it objectively, as well as in order for the 37th highest priority to compete with us, they have had to make the market less fair. They've had to use tactics and approaches that are at times seemingly draconian to the marketplace. And I believe that has created a risk for big Google that is not worth it. So I believe that has likely been escalated to Sundar, and because those decisions have had to go under great scrutiny, things like Jedi Blue and Bernanke and all those things that have had lots of headlines, have made it so that what was previously a part of Google that was ignored by the CEO is now a part of Google that represents a risk. And also, I think if we do really well against priority number 37, it likely has a domino effect into the rest of the business. By the way, therein lies the problem, that so much of this tech is integrated into each other at Google, that unraveling it and making certain that it's fair is extremely difficult to do at Google. It seemed to me that the strategy before was to let every division operate independently, but there became a moment where they started to work together and started to create incentives across different assets. I think that has created a risk for Google. That has also made it so that Google has created the illusion of competition on the sell side. So I said before that I was only half right about the sell side would fragment. The sell side has fragmented, especially in connected television, because connected television is extremely competitive. And by the way, it's perfectly concentrated, which I'll reiterate in a few minutes. But the rest of the internet is not as concentrated. And Google has a bunch of tools and techniques to make it look like there's more competition than there is. I actually had contemplated going into great detail about how this happens. I think I'll save it for another day. There might be a time where we'll publish an invitation. You're all welcome to come. It will likely be after earnings. And we'll walk through what exactly has happened to the sell side. I believe that backdrop is really important to understand the state of the landscape, but also to understand the opportunity. So this is probably the most text-dense slide that we have, and certainly one of the more controversial ones. But I believe that Google's had a negative impact on the ecosystem and competition. And that's in large part, for those of you that have been with us since the very beginning, in order for us to take a meeting at the IPO, we asked people to watch a 12-minute video on header bidding. Without header bidding, I don't know if the trade desk would have had the opportunity that it did. Because what header bidding essentially did is it made it so that there was an if statement in front of Google's ad server. It made it so the open internet created better price discovery. And a publisher could manage yield without relying on Google the same way that it had in the past. The FP was still in the middle, but some innovative companies like Index Exchange created hacks to make it so that Google's decisioning was weakened. Google fired back by creating a product called Open Bidding. I think it's the most deceptively named product, perhaps, in recent ad tech. It was not open or transparent at all. I would argue that its biggest victory was pacifying SSPs to stop doing publisher development and just rely on Google. None of them could afford to interact with publishers on a regular basis and win client relationships with them for less than 5%. So just letting Google pay them to do it meant that Google secured their place in the middle. And it makes it extremely difficult, I would argue even impossible. I've heard SSPs argue impossible for them to disrupt Google as the yield manager. And then there's other programs that created things that are more one-sided. All of this is built on top of the search demand. So if you don't enable Google to use these tools as a publisher, then you do not get access to the millions of advertisers that come from search. I think it's telling that Google has had to rename their products over and over again. They don't use terms like exchange anymore. I think that's because what they do isn't an exchange. It doesn't create transparency or price discovery. It's not built on fairness, which is what I believe is at the core of what Google does. So why take the time to talk about this today at Investor Day? I would say, one, to understand the landscape and to understand that if we have won and done so well in a market that is unfair, if we found ways to do that, and if Google is under greater scrutiny than they've ever been from governments all over the world, not just in the United States, but all over the world, you would think, especially if you really understand the risk that's being taken there and the reward, that is not likely. I don't believe it's rational for Google to continue that from a strategic standpoint. The only way that it gets there is if you let those 37 priorities or 50 or whatever it is operate independently. But as soon as you start thinking holistically, protecting the company, then the risk reward is no longer worth it. I think it's highly likely that the Trade Desk will be competing in a much fairer market as time goes on. And if we've won in an unfair market, imagine what we can do in a fair one. And I believe, and I said this at the last Investor Day, that it is highly likely that the connected television is the way that walled gardens come down, and at end state there will be no walled gardens. Understanding the current state of the landscape, I think, helps you understand the dominoes are falling in our direction. The pressure that has been building on Google has made them, at times, act more aggressively in order to preserve what they have. And I believe that creates a risk reward that is not worth it for them. And you don't have to go very far to not be looking, or to see headlines that are scrutinizing that. Incidentally, and I'll talk about this in a second, one of the things that we've done is we turned off open bidding. And it's had a very positive effect on what we did, but it also was another instance of the Trade Desk leading the open internet, because a lot of other DSPs, including Yahoo and Amobi and others, turned off open bidding themselves. And when we did, we publicly said that we did not believe that it was a sufficiently fair or transparent market for us to continue to transact in. Because of this backdrop, I would also argue that journalism is struggling more than ever. And what I mean by that is not that there isn't quality journalism. Of course there is. What I mean is that it's very hard to pay for it. And journalism, as you all know, has been struggling to monetize properly, to really understand the internet and transition to a digital world. And that has been exacerbated and worsened during the pandemic. I think, of course, because that plays a critical role, especially in more democratic governments, I think this adds other pressure to the walled gardens and those that have very high take rates to do something different because of the effect on the system. But there is also an opportunity, because that is very fragmented. By the very nature of journalism, it's very fragmented. That creates an opportunity for the open internet. So as the open internet is looking for a way to rally all of these disparate companies and different interests, journalism becomes one very important binding entity in that cause. And we'll talk more about some of the things that we've done to begin helping journalism. So this is one of the best things that happened in our ecosystem during the pandemic, and it happened without any fanfare, any attention at all. More words will be spent on this, but the data ecosystem has been cleaned up, and our very best days are ahead. So we'll talk more about exactly what we did there. But lastly, everyone stayed home and streamed during the pandemic. So we did. TV landscape was shifting, and 10 years of evolution compressed into 3 years, basically. So what that shift did was it made it so that COVID accelerated, of course, the consumption of CTV, but it also accelerated the decline of linear or cable television. And sports, which if you listen to surveys in early 2020 or even mid 2020, you ask people, what's the number one reason you hang on to cable? Sports was number one reason. And then when most of sports got canceled, the reason to hang on to it also went away. And so it accelerated the decline of linear and cable. I said, incidentally, at the last Investor Day, that traditional television and cable television is a ticking time bomb, that we have mistakenly created like 3% declines, and that will go on for 20 years. That's not what's going to happen. It's going to get to a place and then fall off a cliff. And it does accelerate as it becomes less and less economically viable. We're already at that point where it's accelerated. The pandemic accelerated that, but then its lack of economic viability. Most of the big traditional media companies at the beginning of 2020 said they have 7 years. There's pretty much consensus among them now that they have less than 3 to make the transition to digital. By the way, I'm not suggesting that they won't do well. Many of them have become very focused on CTV. I've loved our partnership with Disney, and it's been a market leader. One reason for that, aside from them just having very smart people that are thinking about this all the right ways, is that they have been valued on Disney Plus. It's just pretty amazing to hear all the discussion from investors around Disney Plus and less discussion about theme parks and just all the other parts of their business. When you couple that with the other two, Netflix and HBO, who all, I think it was within a 90-day window that all three of them said they were going to introduce AVOD offerings. That represents the biggest surge in CTV inventory and opportunity that we've ever seen. So I keep talking about how the wave of opportunity keeps getting bigger. Well, that wave, I believe, it continues to grow. And I think what will happen in Q1 when all three of those really expand their inventory in AVOD represents a game change, and I think is really important to the healthy evolution of the open internet. So incidentally, it might not be lost on some of you, and might be lost on some of you. But the privacy woes of some of the companies like Facebook that have been really negative affected by social or by the privacy. All of social really has been affected by it. Makes it so that when that media is slightly less effective, people are looking more towards areas that are 100% authenticated and don't have the same issues. So when you're looking for signal and have quite literally an identity crisis throughout all of social, and then inside of connected television, almost everything is logged in. It just creates a very stark contrast for a marketer. So the pressure on Google continues to make brands look for alternatives. So one other takeaway of just all the things we were talking about with Google is that brands more than ever are looking for alternatives. So they're often coming to us. And we used to start discussions saying, how can we win budget from Google? And we started that. And there are often now brands saying, how do I move budget off of Google and onto you? Where they're initiating the conversation. The asymmetry has become more intense for brands than it's ever been. As I mentioned, the data pipes have been replumbed. We'll talk about that in a second. The inventory has gone up and in CTV, and Q1 will be the biggest influx that we've seen, is my prediction. And incidentally, any economic headwinds to the consumer will accelerate that. Because at a moment where all of them are looking for more subscribers, saying, would you like to pay more so that I can continue to fund the content, is not really an option. So AVOD becomes a more important aspect to every one of their businesses. The bottom line is CTV is enabling the open internet to get the very first dollar. That's never been the case before. So when I stood here 3 years ago, programmatic and the open internet was pretty much getting the leftovers. That was the majority of the time. The first dollars went to Google and Facebook. We got what was left. Even in big brands that were trying to be progressive and move towards the open internet, many of them were saying, I want that to be true, but it's not true yet. We have work to do on the open internet before we can. I want it to be true. Let's keep plugging away, is the way I would summarize the sentiment of 2019. Now, more and more, the very first dollar is going into connected television, and that's creating an opportunity for everybody in CTV, and especially those of us that are objective and don't own any content. It's hard for me to overstate the significance of Netflix entering this space, in part because so many of the content companies are afraid of them because they've done such an amazing job. And I've even said this to Reed Hastings. I'm just blown away at how they've managed to recreate their business again and again. Right? I mean, it started with DVDs, then they started repping other people's content, then they became one of the most successful content creating machines ever. And I think because of that ability to pivot all three of those times, I think it would be a mistake to bet against them when they pivot for a fourth to welcome ads, which is, of course, different than what they were saying a couple of years ago. Of course, I said at our last Investor Day, and I think the one before that, certainly I said it before then, that Netflix will eventually have to show ads. And that's largely just because we created models that showed that at some point you have to create so many rate hikes that it becomes cost prohibitive. If you look at the history of television, even if you just look at TV from 15 years ago, you had 500 stations on your cable package and 495 of them had ads, and even then you were paying more than $100 a month. When you put all of that together now, and the content is so much better, and the content is more expensive, the average consumer can't pay $300 or $400 a month to get rid of the ads. And when you look at companies like Hulu, soon to be wholly owned by Disney, they make more on the ad-funded users than they do the others. With 80% of their consumers roughly saying that they would prefer to see the ads than to pay more for the content. And so if you believe that economic pressure and competition is even more likely to make that true, you can see why I'm making such bold predictions about Q1 being a place where inventory surges. So I think it would be a mistake to bet against Netflix. I think it's also important to note that because Disney has done such a phenomenal job of thinking about personalization and privacy and balancing those two things, I think they have also created case studies that Netflix will borrow from. Of course, Netflix hasn't been in the ad business for long at all. You could even argue they're not in it yet. But I believe they're thinking about it the right way. I think Greg and Reed are doing a great job of getting up to speed. And I believe that they and Disney and a number of others will represent a faster clip of change just because we'll have more horses in the race, if you will. I do think they also understand the value exchange for consumers, which is they want fewer ads and they want them to be more relevant. If they don't have one of the best ad experiences in the space, it will be detrimental to their company's future. And so they have to provide relevance, a light ad load, and of course they also have to respect the consumer's privacy. But both of those things have to be respected. If you just respect privacy and then show tons and tons of ads because they're irrelevant, it's not good enough to maintain the amazing experience and be the leader that Netflix has been historically. So advertising fuels and leads growth around the world, and I want to talk about the ways that the Trade Desk has been doing this and what we're going to do going forward. So from the last 3 years, you all know this, you all have been a part of it. I want to thank you for your belief in us, and I also want to just take a minute to just say how happy I am that we've done this together. And not only did we, of course, make the stock price go up in that time, but we've done, I think, an amazing job together of making the open internet more viable. And it's not possible without our investors. We have become closer to advertisers and brands and agencies than ever before. And so we have gone in shoulder to shoulder with the agencies to get closer to the brands. 5 years ago in particular, if we wanted to talk to a brand, often our agencies were resistant. They were afraid of what that meant. Now, in part because of the backdrop of pressures from big tech, they often ask us to do it. We go in shoulder to shoulder trying to help the brand do the right thing. Incidentally, when you bring all three to the table, occasionally brands and agencies' incentives get misaligned, and agencies aren't necessarily always thinking long-term about the brand's best interest. When you bring them all together, that stops, and you get much better. And that has happened over and over again, where because of the three of us being at the table together, brands and agencies are more aligned than ever, and we're more aligned with both of them than we've ever been. We've been moving a lot of MSAs to JBPs, or joint business partnerships, where we're creating incentives for growth. So it's not just here's an MSA and here's your rates, but let's create a partnership where if you reach certain growth measures, if we do certain things, if we do the right thing and focus on decisioning and better data usage, then we create incentives in all forms for them to do the right thing, which because we've aligned our interests so well, these JBPs are just a beautiful part of our business. Of course, we've had a 34% 3-year CAGR over the last 3 years, and premium video has become our largest channel. We transitioned UID to UID2 with a just amazing pace and clip. I'll talk more about that in a second. We launched OpenPath, and we stopped participating in Google's open bidding. Solimar launched on 7.7, without a doubt our most successful release in the history of the company, where in less than 1 year, we moved over 100% of our client base. So it's not very often that you do that. I mean, I still have to update my Apple operating system to, I think, the last 2, right? It just takes so much time for me to do it. When 2 back up, then you really need some time to do it. So moving over 100% of the client base is something that doesn't happen very easily in 1 year. It's a commentary on the quality of the product. Shipping quality product during the pandemic was admittedly harder. And as I look at the bugs in other software all over the internet over the pandemic, it makes me more proud of our team for what they accomplished and what they shipped in Solimar. Again, we did more transformation in the data marketplace in the last year than we have in the last 12. We'll unpack that in just a second. And then we also managed our culture through. So let me talk about our path forward. So first, the night before we went public, I've shared this with some of you before. I was just agonizing about if this was the right decision. Some people think that going public is like an exit, and it's laughable because it's exactly the opposite, right? You're signing up to do this for a long time. We were signing up to get big. That's the way that I looked at it. We were going to be a very big company, and we were going to continue the fight for a very long time. So why did I think that we could win? I mean, here we are going out less than $1 billion company, at least at the time of the IPO. That changed in a matter of days. But why did I think that we could win? And literally, the night before we flipped our S1 public, and I told our entire company, which for me is kind of like going home and telling your mom and dad you're getting married at Thanksgiving or something, where once you tell the team, it's over, it's happening. And as soon as we told the team, we also just pushed the button to flip it public. But the thing that I was ruminating on over and over again was really, there we go, this point, which was that objectivity wins trust with advertisers' first-party data. So I had a conversation with one of the biggest advertisers in the world shortly after we went public. Because it was the CMO, even though the team knew us really well, he didn't. And I said, we built this whole business for you, to align with you. Really, our whole business was designed so that this conversation would go really well. And that's a good way to get people's attention, by the way. He responded by saying, unpack that. And what I said was, I believe the only way to compete with a company like Google, who has just unbelievable data in search, I mean, we share our thoughts with them, but the only data set that is more valuable to you than all that search data is your data. If you know the 100,000 people that buy your product on an annual basis, and then you can look-alike model against those, and you can find other people that look just like them, that is way better than anything you can get in search or social. So really what I have to do in order to have a data advantage is win trust. The only way that I can win trust is if I promise to never own media, to never compromise my objectivity, and always align my interests with you. By the way, there's economic incentive for me to do that anyway, simply because there's more supply than there is demand, and it will forever be a buyer's market. So if we align our interests, then I have the very best chance to compete against the biggest companies in the world. Not because we're as big as them, but because we have better tools than them, which are the data of the biggest brands in the world to help the biggest brands in the world. And one additional risk, aside from all that, if that isn't enough, is that if they were to take that data and send it to somebody who owns inventory, whether that's in CTV or in something else, then you're essentially saying, here's all the users to gouge me on. Let me give you all the data so that you can know which impressions I want the most. And that's, of course, better handled by somebody that aligns their interest with you, as well as has created one of the biggest data marketplaces on the internet so that you can join your data with other third-party data and use that really well. That is only possible if there's a common currency on the internet like unified ID. So if we were to go back and redesign the internet, no one ever would have set up cookies to be what they were. Cookies, the way cookies have been used in advertising have been something of a hack. It wasn't ever designed to be used that way. No one ever expected that you would have like syncing happening with 27 pixels at the bottom of a page every time you land on a page. And of course, the internet will be much better as it moves to an opt-in internet, and that's one of the things that UID is aiming to do. But I don't think enough has been said. I don't think we've said enough, and it's only in forums like this where we ever really have enough time to explain. But the way that you create a common currency and change the infrastructure of the internet is to start by partnering with the infrastructure players of the internet. So even in parts of Google, we've created partnership because it's in the best interest of those, priority 23 and 31 at Google. It's in their best interest to partner with those common currencies, especially when AWS has adopted it or Snowflake has adopted it. So, and I don't mean to minimize the 500 or 600 companies that have adopted UID. Those are significant. And the fact that we've done that in such a short amount of time, unbelievable that this team has done that during a pandemic to create these sorts of partnerships. And the level of personalization that this creates inside of a company like Disney, where you across everything you do can create better personalization, which Disney is very clear, their vision is very clear that personalization is an essential part of a premium experience. And digital personalization is a very important part of a premium experience. And of course, so is privacy. So leveraging this alongside with all of these other companies, it makes it inevitable that thousands of other companies will adopt it. And I believe all the biggest risks to UID as it relates to adoption have been addressed. And as we're seeing the infrastructure players of the internet adopt it and implement it, our biggest problem has instead moved towards how do we bring people on quickly enough rather than just will they buy into the concepts. So the internet is moving to opt-in. It's not there yet, but it is moving to an opt-in internet, and that is a better internet. And in order for it to really happen, it has to happen across the open internet. It can't just happen inside of a single ecosystem. So I want to introduce you to a new product that I don't think many of you have heard about yet. This is in a private beta right now, which is a pass for the entire open internet. And so what this enables publishers to do is join their user bases. And so one of the challenges, for instance, that faces journalism. Oh. Yeah. One of the challenges that faces journalism is that in almost all of them, less than 5, actually I think it is in all of them, less than 5% of their ad impressions are during a login. So in other words, if you're on Apple News or on Facebook or wherever you find a news article, you click on it, you go to the other page, you're not logged in. Typically about 99% of the time. So what that does is that in a world without cookies, that would mean that you have less addressable advertising 99% of the time. So in a world where journalism is struggling more than it's ever been, taking $10 CPMs that are based on personalization, turning them into $5 CPMs because they're not, is economically devastating. So instead of creating a different login for every website, so that you go log in everywhere, or instead of creating that sort of annoying pop-up that happens on seemingly every e-commerce site or every furniture site where you get there and I just want to look at a couch. Why do I have to give you my email address? And then you give it to them and then, what? Now I got to give you my phone number? Like, well, you tricked me. You said I only had to give you your email address. And how can I trust you to deliver my couch on time if you're going to do this? Instead of that game, what can happen is you authenticate your email address one time, similar to another SSO. But that SSO is not tied to creating a new email account or anything. You use the email that you already have. You authenticate it, and then when you go to other sites, all you have to do is click to opt in for that site, and you can opt out of any of the individual sites that you've opted into. So one by one, you can sign in to every site, and with a click, you can take advantage of the authentication that you've already done. The easiest comparison to this is actually in Shop Pay or from Shopify, where to most consumers, in fact, the first time I signed up, you fill out all the stuff, you go to there, and then you go to another site, you see Shop Pay, you plug it in, and you're sort of blown away the second time by how easy it was to do. And that's essentially what we're doing with OpenPass. And what that does is it makes it so the 1% at this news outlet can be joined with the 1% at this news outlet. And consumers are actually more likely to visit the sites. Same way that, by the way, I am at ShopPay, simply because I know that it's easier to transact there. So if I know that a merchant uses ShopPay, I'm more likely to buy there than from somewhere else that doesn't, because I know that it's easier. The same thing will be true with this. It gives an independence to the publishers that they don't have with the current SSOs. So as you know, many of them you go to and you have options to log in with companies like Google, but they don't incentivize to share that addressability. It's actually to create more dependence on Google, not to give them independence. And because we're doing this for the open internet, it becomes a fairly compelling pitch to a publisher who wants to use that, and then it creates more independence. So we have a queue of large companies wanting to implement this. Like I said, it's in a private beta at this point, but it's one of the things I'm most excited about and wanted to share that with you today. So inside the data marketplace, and this deserves more time than I have today, but there have been a number of problems that have made it so data marketplaces have been really anemic across the entire open internet. Let me take a quick stab at trying to describe what each of those are. So one is matching math. So what used to happen is, like, let's say that the Trade Desk has 80% cookie coverage, and then we get the ad request from an SSP, let's call it OpenX. They have a 40% cookie coverage because they don't touch consumers nearly as often. You know, we look at 11 million QPS. They provide, let's say, a few 100,000 QPS. So their coverage would never be as great. So meaning of the commercial internet, or of users that are commercial on the internet, they have cookies on 40% of them. If you take our 80% with their 40%, then we ballpark have 30% covered between the two of us. Now, if you take a data company like an Experian or an Oracle who's trying to sell third-party data, they often have even fewer touches than those SSPs. So then their data coverage will be something like 10%. You put the 30% with the 10%, and now we have like 4% coverage. So this has made the data ecosystem on the open internet anemic for the entire existence of the Trade Desk. And what it does is it makes it so that you're trying to widen the pools, and in so doing, you make them less effective. Because if you said, I can only get to 3%, and you were saying, oh, these are the people that are in market to buy a Porsche for the last 30 days, that segment is so small, and when you only have 3% of that segment, then it's no longer worth doing. So instead of doing that, you then widen it and say, you are interested in a car. And then that's less helpful if you're trying to sell luxury automobiles, because the majority of the consumers that are in that segment are not eligible to buy your product. So the biggest way to solve that is to solve the matching problem so that you have 100% overlap. So instead of the 80-40-10, you have 100-100. And the only way to do that is with a common currency like UID. So one of the first places we start is actually not in running to create a campaign to put in front of 1 billion consumers, which some have wrongly assumed that that's what is required in order to change the infrastructure of the internet. Instead, it's to go to data companies and say, if you adopt this, we will have 100% match rate with whatever gets onboarded from advertisers, so that you can layer your data with theirs 100% of the time. So even if that audience is small, uploaded from an auto manufacturer, and they say, here's my 5,000, now you can layer on top of that 100% of the time, because you both have exactly the same currency. As a result, the segment can change. So the incentive before this was for the segments to get bigger and less relevant. Now the incentive is to get smaller and more relevant and more impactful. Most of third-party data has also been bought by scrolling and clicking. So instead of doing lookalike modeling, partly because of that math problem, we have made things automated. So one other thing I just skipped over on the fractional pricing is that when you segment and you are constantly anding, so like let's say that you buy age, gender, income from 3 different places. If you buy one and then you buy the other, usually when you add a second data element, it doesn't create as much impact as the other. The curve is asymptotic. It flattens. But if you just make the cost linear, because the second data element isn't interested in saying, I would love to take half as much as the first one, but that's what you would have to do in order to pay them in a way that made it cost effective for the advertiser. So instead of doing that, why don't we look at the relevance of every segment, make certain that we layer them on the media decision as often as possible, and then pay them in direct proportion to the relevance that they provide for that particular campaign. We've created a system, though while more complicated, 100% automated, and what it means for the data companies is their data gets used way more often. What it means for the advertisers is they make data-driven decisions way more often. But it also means that the pricing becomes cost-effective, so that you're dividing it up instead of multiplying it as it becomes less effective. Because, of course, if you layer 37 data elements, it's not 37 times more effective necessarily. And, of course, it's not linear. So we've essentially solved the matching problems, the scrolling problems, the efficacy problems. Next up is price discovery. So what we will do in our product over the next year is make it possible for the data companies to see what's being used and create price discovery for their data segments. What most don't know is that there's been no price discovery for data owners in the third-party data ecosystem, and that has also contributed to the data ecosystem being anemic. So let me touch quickly on just the supply chain. So what happened when we turned off open bidding? So of course, because walled gardens don't have a monopoly in CTV or audio or immersive gaming, they of course are trying to get in. But because authentication is so common in all of those experiences, this created a huge advantage for those formats. And the spend that we were spending on open bidding moved to CTV. That was actually a little bit of a surprise to us in the sense that the like for like would have meant that it went to other forms of display, which is often where OB was being monetized, but it didn't. It moved towards those things with more authentication. And of course, because CTV is perfectly fragmented in the right sizes, this became a significant way to reduce the advantage of walled gardens. So there's another product that I want to just talk about for a second, and that's OpenPath. And if it bothers you, like it does some of our employees, that these are so similar to each other, OpenPath and OpenPath, just remember that OpenPath is something for consumers, and OpenPath is something for publishers. So this is a B2B product. And what this is it makes the same day that we announced that we were no longer using open bidding, we introduced OpenPath, which is a way for publishers to plug in directly to us. So many of the biggest publishers, I met with one of them yesterday. It's so fascinating how different the dialogue is now versus 3 years ago. 3 years ago, they were saying, hey, we'll work with SSPs, or you're on the buy side, we're on the sell side. There was a gap. And now there's, how can we work together? And we start every discussion by saying, we're here representing the buyers. We are on the buy side. But to the extent that you want to do your own yield management, we are happy to have you plug in directly. And again, for those of you that want to attend a session after our earnings where we'll talk about the supply chain, we went over some of those very same concepts with some of the biggest publishers recently to get their take on how opaque things can be on the other side of DFP, that it makes it so there's strong incentive for them to take control over some of their yield management and plug it in directly with us. So I do believe that shopper marketing can and will be one of the largest drivers of incremental growth over a 5-year period. Again, there's shopper marketing, which includes loyalty programs and sponsored listings, as well as retail media. And then there's a smaller subset of retail media. Sometimes we use those terms interchangeably, and we shouldn't, because one is a subset of the other. But that's in part because many of our retail partnerships, and we've just made so many retail partnerships since we last met, including companies like Walmart and Target and Walgreens and Home Depot and just so many others. Those partnerships are largely about fixing a measurement problem that is partly brought by the demise of cookies, but it's also because measurement has not been very effective in the open internet. And now to make it so that you can show an ad to a consumer and then see when that same consumer actually buys it in a brick and mortar store and connect those dots end to end creates a level of efficacy in the open internet that we've never had before, at a scale that we haven't had before. And so we have very similar dynamics happening in retail media that we have happening in CTV, which is when you get the biggest in the world competing with each other to make it more efficient and better and to win share, competition actually fuels the innovation, and that's what makes the ecosystem better. So there are parts of the ecosystem where there's adequate amounts of competition, and it is going faster than ever. And retail media is one of the places where that's happening. We launched in Solimar what we call our measurement marketplace. And in fact, in the release that we'll do in the middle of this next year, one of the things that we have to improve on is making it easy to sign up, because it seems like every marketplace, either it's somewhat anemic and you're trying to get things like apps to participate so that people will use the marketplace and join it, or you're overwhelmed with so many people participating that you have to do curation and try to prevent crap from being loaded in there. And we've gone from having the first problem of, we want people to join, please come join our marketplace, to, wow, there's so many choices here, it's overwhelming. And that is what we have to address in our next release, which I'm just so excited about the ideas that we have, as well as what that means. It's the sort of problems you hope for. So one thing I just want to just prime is that it is not lost on us that inside of that $1 trillion TAM, there's a bunch of spend that comes from S's and M's. I at times don't like the use of the acronym SMB in our own four walls, just because S's and M's are very different. And because most S's and M's market on a few websites that are massive, the YouTubes and Facebooks and Instagrams of the world. But of course, there's just so much that can be done for them on the open internet as well. Just the difficulty there is in making it simple. Like arguably the greatest thing that Facebook has done is creating very simple on-ramps for S's. And there's an opportunity for us to do something like that. I do believe it requires us to get closer to the consumer, and we're spending more and more of our time and thinking about what that means for many years from now. So I don't think it's anything we have to do to address the opportunity in front of us. In fact, I'm daunted by the massive tidal wave in front of us of opportunity that is largely about the largest players. And when we talk about OpenPath, we're largely talking about many of the biggest publishers. So if you think about the top 500 advertisers and the top 500 publishers, that represents the majority of the head in both of those curves, where there's a big head or fat head and a very long tail. But the tail is also very long, and it covers as much or more surface area simply by being almost infinitely long. It's not lost on us that there's opportunity in that, and especially when you're in the business of powering and enhancing the open internet. that's very different than trying to help a single destination. So it's something we're very interested in. So as I've said before, to be one of the 10 at the finish line, you have to be global, you have to be omnichannel, and you have to have a unique data advantage. I think we spent some time talking about what those are for us. So we will create a forward market. This is very important for transitioning the upfronts, but into something more sophisticated, and we call that the forward market. Our partners have to be able to build to us. We have to continue to make CTV decisioning enhancements, especially as more and more inventory comes online. It makes it possible for us to use data more and more and be more selective. So our value proposition in CTV is going up as it relates to that. And then, of course, to continue to make data enrichments. So we've talked about this already, but there's new supply and partnerships coming online. There will be better measurement. There will be more data layered on this, and there will be a much better supply chain. To just think about what we're after here, all of TV is roughly $250 billion, depending on whose numbers you use. CTV is ballpark $16 billion. But if you divide that up and look at what's decisioned, which, by the way, Tim's going to talk a lot about why the future of CTV is biddable, you'll see that we've merely scratched the surface of where we're going, and that we've managed to win the lion's share of that decisioned spend. So the last thing that I just want to touch on is investing in our culture. So what most, I don't think a lot of people have talked about what happened to corporate cultures during the pandemic. It was the hardest time of my career to lead. It's hard to lead remotely. And I've said internally, like, I feel like I used to make decisions on 97 data points, and now I make it on like 11. Because it's just so much harder to interact. It's harder to take 5 minutes and talk to somebody, and instead you have to schedule something over Zoom. And then the person over Zoom isn't always as open, especially if you have a very collaborative culture. But our culture was always built on hiring great people who are very collaborative, that get along, that have high EQ, that also share common values and common vision. And because we've had this singular vision, it's been something where I believe what every company has done during the pandemic is make withdrawals from that cultural piggy bank. I think it's been almost zero deposits. So during that time, just making the withdrawals, it was something that, because we had so much saved and we had so much focus, I believe we grabbed more land during the pandemic than any other time. And I believe the same thing can happen and will happen if there's economic downturn, that we will once again rally around a very common vision and the impact that we can have on the open internet. The wave of opportunity continues to get bigger. CTV is getting the first dollar, and it is moving up the prioritization for advertisers. And what we're doing fuels and leads global growth. So in the same way that tech often does that, I believe advertising does that for tech and for everything else. I just want to say thank you so much for the time today. Thank you for being our investors, for believing in us, and for taking the time to understand our business. There's so many people here that I've spent a lot of time with over the years, and I just really appreciate your support and your willingness to learn this esoteric, complicated ecosystem. That complication is one of the things that actually is a bit of a moat around this ecosystem, because it prevents people from getting in it. It's very difficult to understand, but it is an opportunity that continues to grow, and it will only continue to grow. So thank you so much.